So gold prices just plummeted. What that really is telling us is that people are relying on the dollar more so than they are gold. They're going to up interest rates. So this is how people who lend money, they make money when people borrow money. So if they up the interest rates, then people would feel more comfortable with having the US dollar versus gold. Gold dropped to 4,500 an ounce. It was over 5,500 at the beginning of the year. And so this war in Iran, that's part of it. Also have fears of inflation and high energy prices. So folks right now are paying the pump than they have in quite some time because people are going to be paying more for those companies to have to charge more for goods and services, essentially, because now it's expensive for them to move the goods and services across the country because a lot of that is done through shipping. And if gas costs more for us at the pump, but driving cars, it costs a lot more for people that are driving trucks and companies who have trucks going back and forth across the country. Ultimately, that price is going to hit your pocketbook. Anytime you hear gold is going down, to me, that's just an indicator of inflation going up, recessionary fears going up, prices of goods and services going up, gas going up. You can always look back, of course, at 2008, 2009 with the housing bubble burst, but also look at like 2016, of course, in 2020 when COVID happened, when we had those major pullbacks. And a pullback is anywhere from 3 to 10%. You can always look at gold. You'll see a lot of people were putting their money into gold. So for it to be happening in an opposite factor right now is just like very alarming. Our stock market is down. Crude oil prices are up, like I said, and now we got gold going down as well. With the rates being increased, essentially what that is going to mean is we're going to reverse everything that we put in place here in the last 4 months in regards to the housing market. So we have started to see a little uptick. People are going back and getting more interested in buying houses because it was a little more affordable. But now think about it, you lost 200,000 jobs already in 2026. People won't be able to purchase the homes because they don't have a job unless they do the ninja loans, no income, no job, no assets. Two, if the interest rates go up, less people are going to want to sell their homes because if they sell the home that they're in now, where they have a 2% interest rate, they have to go back into that same market with those same dollars now and buy back into the real estate market. Most people are going to say to themselves, I'll just stay where I am and I'll wait for this wave to kind of die down. What he's trying to do is make sure that inflation stays low. And so they're going to have to raise interest rates to make it more expensive for people to borrow money. He dictates to the new Fed chair when to drop rate, and we're still in war. That's not going to be good for our overall economy, partly because now you're manipulating the market and you're not letting it have its actual real timelines where it essentially will kind of fix itself or flatline. Think about this. If everybody is getting free money, then no one is making money off of the lending of money. And so the whole system basically collapsed on top of itself because nobody's making any money. So we had zero interest rates for a really long time. And so bank stocks didn't do well during those times because they couldn't make any money lending money out. But when interest rates goes up, then of course that helps them create revenue. So if interest rates goes down, it makes it cheaper for everybody across the board. So bank stocks, they'll go to retirement money. It's a little bit of a trick question because we are going from a hawkish Fed to possibly a dovish Fed, meaning that we're going from someone who wasn't a party participating at all in Jerome Powell to someone who may potentially lean towards whatever Donald Trump says. We just really don't know. With our money, what I'll probably do is look at diversifying a little bit more. If the new Fed comes in and he holds the rates up or he ups the rates, then bonds are going to be a good place to be able to diversify in. Not 100%, of course, maybe a 1/4% of what you're investing, but that's a good place to get a return. But ultimately, the stock market is going to recover. We're in a pretty moderate pullback right now. We're probably down about 4 to 5%. from the all-time highs. So we're not quite in like hit the red button, all alarms blaring. We're not there yet. We still have some ways to go. But from where we were to where we are now, that it is a pullback. People are losing a moderate amount in their retirement accounts. So it's important to stay plugged in and stay focused all times. Yes, it can be difficult. Yes, it's a lot. But if I were to ask most people, like, how did Stranger Things end? They would spend 2 hours explaining it to me, but they can't explain to me what's going on with their money, even though it's their forever retirement and their generational wealth that they hope to pass on to their children's children. So if you're someone who's going to retire pretty soon, the next 2, 3 years, maybe, then you may want to just put your money in a cash position and just let it sit for right now until you can kind of weather the storm and see what's going to happen. If you're someone who just started working a couple of years ago and you have hopefully another 25, 30 years of working, you're okay. Put your money in the stock market, continue to dollar cost average, continue to invest there. If you're somewhere like in between, it's important that you diversify though. So you have to have some hedges in place, and you're going to have to actually keep an eye on what's going on in the market, because the people who manage your money, they're pretty much just going to do whatever makes the most sense for the overall company, not you individually. And that could affect you individually. If you're already in retirement, well, hopefully you've rolled your money over to like a fixed index annuity. So it's not still in the market. Once you retire, you don't want your money, not all your money at least, in the stock market. Again, diversification is really the key. So a portion of your money, yes, in the stock market for the long run. But let's say you want to live off some money for the next 10 or 15 years and you don't have a pension, then a fixed index annuity would make the most sense, because you have your money in a state where it won't lose, but at the same time, you can take gains if the market starts to recover. And then you get the free withdrawal that you can take out every year. And then, of course, you can use that to live off of. And they're not all the same. So it really depends on where you are and what you're looking at. And there's good and there's bad in anything that you look at in the financial services. That's why it's important to understand it for yourself and not just let someone dictate to you. Even myself, we manage over $15 million of retirement funds, but I still make sure that I explain to my clients what we're doing with their money. I don't want them to just trust me blindly, because that's why you have to review it every year and make sure that you know what's going on with your money. No one will ever care as much about your money as you do. When times are great, that's when you should be thinking about these things, not when you're in a panic